Well, hi folks, let's talk about moving averages for a few minutes. A lot of people ask me, what are the moving averages that I have on my charts? So I'm going to show you the 4 moving averages that I use. I'm going to put them on this chart and show you how you can use them to interact with other technical indicators that you might be using, like trend lines, horizontal lines, Fibonacci levels, and perhaps candle patterns, that sort of thing. So I use 4 moving averages on my charts, on all of my charts, on all time frames, whether I'm looking at a day chart, a 4-hour chart, even a 5-minute chart, or a 1-hour chart. I put these same 4 moving averages on them. So let's start at the bottom on my TradingView charts, and in no particular order. I've got the moving averages listed here on the side. I'm going to make the first one visible, which is the 100 period moving average, and it's 100 period simple moving averages. These are not exponential moving averages or any other sorts of moving averages, not VWAP, nothing like that, just simple moving averages. Let's put the next one on the chart, and there it's appeared. It's the green line, and that's the 20 period moving average. In this case, because it's a day chart, it's the 20-day moving average. The next one is this purple line down at the bottom. That's the 200 period moving average. And then the last one, the red line, is the 50 period moving average. And you can see in an uptrend, they're all sort of layered on top of each other. The 20 is above the 50, which is above the 100, which is above the 200. And when the trend starts to change, you can see the moving averages begin to cross over. In this case, we've had the 20 cross over the 50. We've had the 20 cross over the 100, and we've had the 50 cross over the 100. Right now, and in fact up until last week, the 20 period moving average, the green line, was heading down towards crossing over the purple moving average, which is the 200 period moving average. Now, I don't use moving average crossovers. There's one way to do that apart from just looking at the moving averages on your charts, and that's using a MACD indicator. I'm not going to go into that right now. I'm not a great fan of lagging moving average crossovers as an indicator to get in or out of a trade, or an indicator that there's any sort of danger or positive nature to a trade. I just don't look at that. What I do use the moving averages for are simple lines of support and resistance, particularly when they're in collaboration, or the word that people use is confluence, with other indicators, other horizontal levels, perhaps channel lines like you can see on the chart, or Fibonacci levels, or even in areas where we see reversal candles forming on the charts. So all this video was to tell you the moving averages I use myself, and to repeat, that's the 20 period, the 50 period, the 100 period, and the 200 period simple moving averages. And I use them on all time frames. And simply speaking, what I look for is short-term momentum determined by the 20 period moving average. That's the green line. As long as the price is above that, then we've got upward momentum, short-term momentum. When the price is below it, we've got downward short-term momentum. Then I use the 50 period moving average as simply a support and resistance line. It's quite an important one. Often when the price gets to the 50, and you can see countless examples here. I'm not going to show you them all. You can go back and have a look at your own charts. But you can see often when the price approaches the 50 period moving average and the 20 for shorter term trends, but the 50 is equally important. The same goes for the 100, although I place less emphasis on the 100 probably than the other 3. And the most important one for long-term trend direction and also for major reversal points on the chart is the 200 period moving average. That's this purple one. What you'll notice is that often the price will change direction when we reach these moving averages, particularly if that price level is in confluence with, let's say, a Fibonacci level, 38.2% Fibonacci, a 50%, a 61.8% Fibonacci, or a horizontal line or a channel line. I've got some examples drawn in here, and I've also got the fib levels drawn on here in these colored shaded zones. What's nice is once you've got these moving averages on your chart, you can switch between time frames. So this is a day chart. I'll switch this to a 4-hour chart, and the moving averages automatically get transferred across onto the 4-hour chart. At this point, I'd encourage you just to give the video a thumbs up if you're finding this useful, and perhaps consider subscribing to the channel. And also, if you want to get TradingView charts, the pro version, free of charge, it might be worth looking at Black Bull Markets as your preferred trading broker. And there's a link below. If you use that link, you will get free TradingView charts, the professional version, which will help you immensely in your trading. So just quickly looking at this 4-hour chart, you can see some of the top levels here. We're right against the 200 period moving average. You can see how we bounced off the 50 and the 100 confluence there. You can see how we moved through the 20 there after it was resistance on many occasions. And then once having broken through, we came back and tested the 20 from the top side and then began to move up, then through the 50, then through the 100, then the 200, and up she goes. I could switch this to a 1-hour chart as well, and although we've had a very extended move, you can see how we've bounced off the 20 period moving average on several occasions. And if I go back into some of this choppy zone, you can see how all of these moving averages in confluence with some of these horizontal lines and channel lines, act as support and resistance. The shorter term time frame that you look at, for example 1 hour versus 1 day, the less important those moving averages become on the charts. And if you want the bigger, most powerful picture, then you need to look at day charts and even weekly charts and apply the same moving averages to those charts to see where those support and resistance levels might be. So this is still the 1 hour chart. You can see another example of how tightly intertwined these moving averages are, often denoting a period of ranging or sideways movement, consolidation or coiling, some people call it. And then as the market starts to take direction and move in a direction, the moving averages begin to spread out and layer themselves on top of each other in the correct order: 20, 50, 100, 200. So you can use that as well as some sort of separation technique. There are various methods that use the separation of moving averages and the alignment as the trend begins to form, like the crocodile method and various other separation methods using Bollinger Bands in combination with moving averages and MACDs, all that sort of thing. And people also combined EMAs and SMAs and VWAPs and all sorts of things together. But I like to keep things simple, and I like to use the moving averages not as lagging crossover trigger indicators, but as support and resistance on the chart. I mentioned weekly charts earlier. Let's have a look at the weekly chart on the same instrument, the S&P 500. And I'll just drag this chart along, and you can see on the weekly chart on the stock markets how often we react to the 20 period and the 50 period moving average in particular. You can see how the 20 period was support over there and over there and over here, and then we broke down through the 20 but just to the 50 SMA, and then that acted as the support level. That happened again on this occasion, and a third time, even a fourth time. And see how beautifully that 50 period moving average acts as a support level on the weekly charts on the S&P 500. Of course, there are some occasions when the markets just blast right through those moving averages and they don't offer the support or resistance that we're looking for, but then the market resumes its normal tone. Once again, we can see the 100 coming into play and the 50 here, then the 20 acting as support again. And once again, in a strong trend, in a good solid trend on the weekly chart, the price really should hold above the 20 period moving average. You can see all the way up in this long bull run, the 20 period moving average was precisely the level that the market returned to time and time again. And then in this recent move down, we broke down through these moving averages, and look how we tested them from underneath. So that 20 period got broken, we came up from underneath, formed a double top and tested it from underneath. It happened again over there, it happened over here against the 50, it's happened over here against the 100 and the 50. And so time and time again, even on these very long-term charts, the moving averages that I've highlighted to you work out as excellent support and resistance levels. In the last couple of weeks, we broke the 20, moved down to the 50, just about touched the 50, moved back to the 20, this time from the underside. The 20 period acted as resistance, formed almost a tweezer top there. So it's a candlestick confirmation as well. Then we got back down to the 50 and the 100, actually piercing it in some very erratic movement granted over the last week or so. And now we've moved back up to the 20, which may or may not act as resistance on this occasion as well. In this example, we can go back to the 4-hour chart. We're looking to short this market S&P at some stage, and all I'll do is I'll put some Fibonacci levels on here so we can see where we might head in terms of Fibonacci retracements. There's the 38%, the 50, the 618, and you can also see where the 20, 200, 100 and 50 period moving averages are, and ideally we would want those in confluence with some of these Fibonacci levels and the horizontal levels that I can draw in on this chart as well. Don't want to make this chart too messy right now, but this is for illustration, so I can draw a horizontal line there, and that sort of ties up with the 100 and the 50 period moving average, and I could draw a line a little bit lower down at this swing low, and that's that Fibonacci level below all the moving averages actually. And then the 200 SMA will probably drop down a bit if this market moves lower, down towards the 38.2% Fibonacci level, and that's where we might get a buy signal. We'll be looking for candlestick patterns and reversal candles to indicate that we have a trigger to enter the trade. Well, I hope you found that useful, and if you've got any comments or questions or ideas, please put them in the comments section below. And once again, I'd love it if you gave this video a like, a thumbs up, and subscribe if you feel like watching some more of this sort of stuff. I'll see you in the next one.